Ever wondered how investors predict future price movements? They might be using a method called technical analysis. This sophisticated approach is used to evaluate securities, not by assessing their intrinsic value, but by analyzing statistical data generated from market activity. The primary focus here is on past prices and trading volume. Think of it as a form of financial astrology, where instead of stars, we chart the movements of stocks. The heart of technical analysis lies in the belief that history tends to repeat itself. By studying past price patterns and trends, analysts aim to identify potential future activity. A key aspect of this method is the use of charts and patterns. These provide a visual representation of market information, making it easier to spot trends and patterns. Now contrast this with fundamental analysis. While fundamental analysis delves into a company's financial statements, economic conditions, and market trends to evaluate its intrinsic value, technical analysis takes a different route. It's like trying to predict the weather by looking at the past patterns, rather than understanding atmospheric conditions. While both approaches have their merits, they serve different purposes. Fundamental analysis is like the tortoise, slow and steady, focusing on long-term value. On the other hand, technical analysis, like the hare, is quick and agile, ideal for short-term trading decisions. However, it's important to note that technical analysis isn't just about deciphering cryptic charts and identifying esoteric patterns. It's a systematic approach that combines statistical analysis with behavioral economics. It acknowledges the influence of market psychology and investor sentiment on price movements, thereby providing a more holistic view of market dynamics. So while the fundamental analyst might ask, "What's the value of this company?" the technical analyst might counter, "What's the market's perception of this company's value?" The answer to these questions can sometimes lead to the same conclusion, and sometimes they might diverge. In essence, technical analysts don't measure intrinsic value. They look for patterns that suggest future price movements. At the heart of technical analysis are 4 core concepts. These pillars are crucial in helping us understand how this method works and how it aids in making informed decisions in the financial market. The first concept is historical price movements. Technical analysts focus on price trends to predict future market behavior. They study how prices have moved over a period of time, whether it's over the course of a day, a week, a month, or longer. This analysis can provide valuable insights into the possible trajectory of a security's price. Next, we have trading volumes. This refers to the number of shares or contracts traded in a security or an entire market during a given period. It is often overlooked, but is a significant aspect of technical analysis. High trading volumes can indicate strong investor interest and can lead to more substantial price movements. The third concept is patterns. These are recognizable configurations on a stock chart that traders believe can predict future price movements. There are numerous patterns that analysts look for, such as head and shoulders, triangles, and flags. Each pattern has its own set of rules and implications that analysts use to make their predictions. Finally, we have indicators. These are mathematical calculations based on a security's price and volume. They help to predict future price levels or simply the general price direction. Examples of commonly used indicators include the Relative Strength Index, or RSI, and the Moving Average Convergence Divergence, or MACD. These indicators can help analysts understand whether a security is overbought or oversold, and if a reversal is likely. These 4 concepts, historical price movements, trading volumes, patterns, and indicators, are interconnected and work together to form the basis of technical analysis. They provide a framework for analysts to examine and interpret market activity, and in turn predict future price movements. These core concepts form the foundation of technical analysis, guiding analysts in their predictions. With a solid understanding of these concepts, you're well on your way to becoming proficient in the art and science of technical analysis. But how does technical analysis work in practice? Well, the magic of technical analysis lies in its fundamental belief that past trading activity and price changes can tell a story about what's to come. Imagine this. You're an archaeologist, and your dig site isn't an ancient ruin, but a vast sea of historical market data. By studying the layers of this data, you can piece together patterns and trends, much like assembling an old artifact. Now, how do you visualize these historical layers? That's where charts come in. Candlestick, line, bar charts. They're like the blueprints of the past. They give life to numbers, transforming raw data into a visual narrative that's easier to understand. Think of them as your treasure map, guiding your way through the complex labyrinth of the market. But a map is only as good as its landmarks. In technical analysis, these are known as support and resistance levels. Picture this: a price that struggles to fall below a certain point is at its support, like a bouncy ball hitting the floor. Conversely, a price that can't seem to rise above a certain level is at its resistance, like a bird trying to fly too high. Identifying these levels can help predict where prices might stall or reverse. Another key tool in the technical analyst's toolkit is the moving average. This smooths out price data to reveal trends that might otherwise be lost in the daily ups and downs of the market. It's like standing back from a pointillist painting to see the bigger picture. Lastly, we have patterns. These are recurring shapes and formations in the data that can signal potential price movements. They're like the constellations in the night sky, guiding sailors on their voyages. Spotting these patterns can provide valuable insights into where the market might be heading. Through these methods, technical analysts interpret past data to forecast future price trends. It's like using a compass and a map to navigate the vast ocean of the financial market. Not always perfect, but certainly a powerful tool in your investment arsenal. You might be wondering about the difference between technical and fundamental analysis. Well, the two are quite distinct but equally valuable in their own ways. Let's start by defining fundamental analysis. This is a method used to evaluate a security, such as a stock, by examining its intrinsic value. Intrinsic value can be a complex concept, but think of it as the real, inherent worth of a security, which is determined by factors like the company's financial health, its earnings, sales, and the current economic environment. Now contrast this with technical analysis, which we've been discussing. Remember, technical analysis doesn't concern itself with the security's intrinsic value. Instead, it focuses on price trends and patterns seen on charts. It's all about the stats, past prices, trading volume, and the like. The idea is to predict future price movements based on these historical patterns. However, while they seem different, there's an interesting potential overlap between the two. Some market observers argue that fundamental factors, the ones used in fundamental analysis, can and do influence price trends. For instance, a company's strong financial performance can lead to increased investor interest, which in turn can drive up the stock price and create a positive trend. So, in a way, the fundamental analysis feeds into the technical analysis. While they are distinct approaches, both technical and fundamental analysis play significant roles in assessing a security's price. They are like two different lenses through which you can examine the financial markets. One looks at the what. That's the fundamental analysis, focusing on the intrinsic value and the why behind a security's price. The other looks at the how. That's the technical analysis, studying the price movements and patterns. So, whether you're a fundamental analyst or a technical analyst, the important thing is to remember that these are both valuable tools in your investment decision-making toolbox. Use them wisely, and you'll be well equipped to navigate the exciting world of financial markets. So, where does technical analysis come into play, you might ask? Well, it's a tool that can be wielded in various arenas of the financial world. From investing to trading, and even risk management, technical analysis holds the key to unlocking potential opportunities and mitigating risks. Let's start with investing. The vast ocean of trading can be overwhelming, with waves of price changes and currents of market trends. Yet technical analysis serves as a compass, guiding investors through this sea of uncertainty. It helps identify the prime moments to enter or exit a position, based on the patterns and trends laid out on the charts. By pinpointing these opportunities, one can optimize their return on investment and navigate the market with confidence. But what about trading, particularly short-term decisions? Here too, technical analysis comes into its own. Traders, especially those operating in the fast-paced world of day trading, need to make quick decisions. Analyzing patterns, trends, and volume data in real time allows them to predict potential price movements and act swiftly. In a realm where every second counts, technical analysis provides the insights needed to stay one step ahead. Risk management is another crucial area where technical analysis shines. The financial markets can be a risky business, and knowing when to cut losses is just as important as knowing when to ride the gains. By setting stop-loss orders based on technical signals, one can limit their potential losses. This way, even when the market takes an unexpected turn, the fallout can be contained. So, you see, the application of technical analysis is far-reaching. It's not just about charts and patterns. It's a strategic approach that can enhance your decision-making process. It provides a framework to interpret market activity, anticipate potential movements, and ultimately, make more informed decisions. Remember, it's not a crystal ball that can predict the future, but a powerful tool that can help you navigate the unpredictable waters of the financial markets. Whether you're a seasoned trader or a curious beginner, understanding these principles can enhance your decision-making process in the dynamic world of financial markets.